You get your first real paycheck. You're hyped. You did the hours. You survived the boss. Then you look at the number that actually hits your bank account. And it's smaller. Way smaller. You start doing mental math like, wait, I worked 40 hours. Where did the rest go? Who stole my money? Welcome to taxes. Specifically, income taxes. Earning more money does not push you into a bracket and screw you. That's not how it works. That's a myth that refuses to die. By the end of this, you'll understand tax brackets, marginal rates, why refunds aren't free money, and how this whole system actually works. Let's fix the confusion. First, why taxes exist. Governments need money. That's it. Roads, schools, public hospitals, police, military, courts. None of that runs on vibes. So governments collect taxes from individuals and businesses to pay for public services. Income tax is one of the main ways they do that. Income tax equals a percentage of the money you earn. Simple concept. Complicated execution? Okay, moving on. Gross versus net. This is where confusion starts. Gross income equals what you earn before taxes. Net income equals what you actually take home. If your job pays $1,000 for the week, gross equals $1,000. After taxes, maybe you get $820 to $900 depending on your situation. That difference isn't random, it's withholding. Withholding equals your employer sends part of your paycheck to the government on your behalf. It's like automatic tax delivery, so you don't forget and spend it all on sneakers and protein powder. Convenient, slightly painful, necessary, cool. Now here's the real part, the big myth. You've heard this, don't work overtime. You'll move into a higher tax bracket and lose money. No, that's not how progressive taxes work. Most modern income tax systems use progressive tax brackets. Progressive equals the more you earn, the higher the rate on the extra money. But, and this is critical, the higher rate only applies to the income above that bracket, not your entire income. Let's break it. Tax brackets. Simple version. Imagine a fake country with this system. 10% on the first $10,000. 20% on income from $10,000, $1 to $40,000, 30% on income above $40,000. Let's say you earn $50,000. Here's what actually happens. First $10,000 taxed at 10%. Next $30,000 taxed at 20%. Last $10,000 taxed at 30%. You are not paying 30% on all $50,000, only the top slice. Think of it like stacked layers, or like leveling up in a game, only the new XP is harder, not your old points. This is called your marginal tax rate. Marginal rate equals the tax rate on your next dollar earned. That's the number people misunderstand, okay? Let's make this painfully clear. Overtime example. Let's say you make $39,000. You're near the top of the 20% bracket. You work overtime and make $2,000 extra. Now your total income is $41,000. Yes, that extra $1,000 above $40,000 is taxed at 30%, but only that portion. You don't suddenly lose money. You still made more, always. More income equals more take-home, just not 100% of it. So please stop rejecting overtime because your cousin said, tax bracket, bro. Okay? Next, effective tax rate. This is different from marginal rate. Effective tax rate equals total tax paid divided by total income. It's the average rate across all your brackets. Using the $50,000 example, you might end up paying something like 18 to 22% overall, even if your top bracket is 30%. So when someone says, I'm in the 30% bracket, that doesn't mean they pay 30% on everything. It means their last dollar is taxed at 30%. Big difference. Huge. All right. Refunds aren't free money. This one hurts. A tax refund is not a bonus. It's your own money coming back. Remember withholding? Your employer estimates how much tax you'll owe and sends that amount throughout the year. If they sent too much, you get a refund. If they sent too little, you owe money. That refund feels amazing, but it just means you gave the government an interest-free loan all year. Congratulations. Still feels good though. I get it. Deductions. Now it gets interesting. A tax deduction reduces your taxable income, not your tax bill directly. Taxable income equals the portion of your income the government actually taxes. Let's say you made $50,000. If you have $5,000 in deductions, you're now taxed on $45,000. Deductions lower the number that gets taxed. Common examples: certain education expenses, retirement contributions, mortgage interest, in some systems, charitable donations. Think of deductions as shrinking the pie before the slices get taxed. Cool. Tax credits are different. A tax credit directly reduces your tax bill. If you owe $3,000 in taxes and get a $1,000 tax credit, you now owe $2,000. Much more powerful than deductions. Some credits are refundable. Refundable credit equals, if it reduces your tax below zero, you get the difference as a refund. Yes, that's real. But it depends on the country and program. Important distinction: payroll taxes. Income tax isn't the only thing coming out. You may also see Social Security contributions, Medicare or National Health contributions, other payroll taxes. These fund-specific programs, they're usually a percentage of income too. So when your paycheck looks attacked, it's not just one tax, it's layers, like onions, but less emotional. The running example, your $3,000 per month job. Let's use this for the rest of the video. You make $3,000 per month. That's $36,000 per year. You're single. No crazy deductions. From that, income tax is applied by brackets. Payroll taxes apply. Withholding happens automatically. Maybe you take home around $2,400 to $2,700 monthly, depending on the country and setup. That difference? That's the system in motion. And now you understand why. Okay, next layer. Why high earners pay more, but not 100%? Progressive taxes exist for redistribution. Higher earners pay a larger share. The idea is $1,000 matters more to someone earning $30,000 than someone earning $300,000. That's called diminishing marginal utility of money. Translation: an extra dollar feels more valuable when you have less. Economists generally agree this effect exists. So progressive systems are built around that idea. You can debate policy, but that's the logic. All right, self-employed? Different game. If you freelance, run a business, or do gig work, no employer is withholding for you. You're responsible, which means you may need to make estimated payments. You track expenses. You handle your own deductions. And yes, you can deduct legitimate business expenses. Laptop for work? Possibly deductible. Home office? Maybe. Business mileage? Often. But no, your PlayStation is not a business expense because you think better while gaming. Be serious. Tax planning, not evasion. Tax evasion equals illegal. Tax avoidance equals legal use of rules to reduce taxes. Big difference. Tax planning is just using deductions, credits, and retirement accounts wisely. For example, contributing to certain retirement accounts can reduce taxable income in many systems, meaning you invest for future you and lower taxes now. Win-win. That's strategy, not cheating. Capital gains. Quick intro. Not all income is taxed the same way. If you invest and sell assets like stocks at a profit, that profit may be taxed as a capital gain. In many countries, long-term investments are taxed at lower rates than short-term trades. Why? To encourage long-term investing. Details vary by country, but the concept matters. Income isn't one single bucket. Okay, final stretch. Why people hate taxes. 3 reasons. 1. It's invisible until you see your paycheck. 2. It feels forced. 3. It's complicated. Also, most people never actually learn how it works. So myths spread, like earning more is bad, or refund season is free money, or rich people pay nothing. Reality is more nuanced, always. Rapid recap: taxes fund public services. Gross is before tax. Net is after. Progressive system equals higher rates on higher slices only. Marginal rate is not equal to effective rate. Overtime doesn't make you poorer. Refunds are your own money back. Deductions lower taxable income. Credits lower your actual tax bill. Payroll taxes fund specific programs. Self-employed people handle their own payments. Capital gains can be taxed differently. Tax planning is legal strategy. That's the system. The real takeaway: taxes aren't magic. They're math. Once you understand brackets and marginal rates, the fear disappears. And when fear disappears, you make better money decisions, which matters more than arguing about tax memes. If your friend still thinks overtime puts you in a bad bracket, send this to him. And if you watched till here, please subscribe. This is first upload to my channel. Cheer me up by liking the video. Thank you.